Boats are for sailing, not for flying. And you should not be asking a boat to fly because that is not its job. Right now, we are asking the monetary system to do things that it should not be doing. Justin, what is the BIS report going over the corresponding banking system?
BS Reports talks about correspondent banking. What the hell is correspondent banking, you might ask? You're not the first. Correspondent banking is the way that you can transmit value, or like the data involving value, without actually transmitting over an asset initially. That's the long and short of it. We'll get more into that in just a second, but that's the key thing. So this was put out by the BIS, aka the Central Bankers Central Bank, in 2016. So the data's a bit stale, but there were several trends in here that I kind of wanted to call attention to. And we stumbled across this while doing research for another video that we're still working on, but again, that's a separate video. Anyways, the point is that banks have traditionally maintained broad networks of correspondent banking relationships. Some banks providing these services are reducing the number of relationships they maintain and are establishing new ones. The impact of this trend is uneven across jurisdictions and banks. We'll get to that in a second. At the very end, there's some graphics that do a really good job of demonstrating this. Anyways, the rising cost and uncertainty about how far customer due diligence should go in order to ensure regulatory compliance are cited by banks as among the main reasons for cutting back on their correspondent relationships. So let me say that in plain English. And this is where it gets back into the boat versus the airplane analogy. When we had the system that was first set up, and so let's say go back to, I don't even know when, Josh, did we go back? It would go back a long time, where if you're a customer at your bank and I'm a customer at my bank and I want to send and I want to write you a check or whatever, right? There's kind of several ways to do this conceptually. Number one is my bank can send your bank an asset. Maybe a modern day equivalent of that would be me sending you a wire, or bank reserves via the Federal Reserve are transmitted from my bank to your bank. The reason this is done is because when I give you money, your bank, when it's credited to your account, basically has an extra liability. You have more DDA liabilities, which are good for you but bad for the bank. And so the bank, in order to be compensated for this increase in the liabilities, they receive an asset. You know, the Fed bank reserves that went over. As you are aware, the vast majority of transactions, you probably don't have a corresponding asset transmitted with the transaction, or there is a corresponding asset transmitted. It's done in batched and probably on a net basis versus a gross basis. Just a fancy way of saying you can also use liabilities to send over information. But when you use liabilities to send over information, you get into this concept of let's say addition versus subtraction. Josh, if I remit a bearer asset to you, you know, a gold coin or whatever, right? Who cares? You know, the asset is the asset is the asset. There's virtually no counterparty risk in doing that. So the reason I say this like addition, 1 plus 3 is the same as 3 plus 1. You get 4. Both ways you run that through. The order of operations doesn't necessarily matter. But the catch to do that is you have to have an asset. It becomes a little bit cumbersome when you don't necessarily have an asset, or if you have an entire system that's created on the lack of an asset. Looking at you, Eurodollar system, but we'll get to that in a second. So the other way you can get around this is you can use liabilities to transmit value. So here's the way to think about it. Prior example, I send you a gold coin if I owe you $100. Or what you can do is you can send me a $100 bill. Example, you can say, hey, Justin, you know, I owe Chase $100. And rather than me pay Chase $100, you Justin, are going to pay Chase $100. So this is me taking on your liability. And so from a financial perspective, you are now have $100 more because you have $100 fewer dollars you owe to someone else. You know, duh, right? But the reason this is like subtraction is because Chase might say, well, wait a minute, Josh, you know, we set up an account with you. You know, we know you, we don't necessarily know Justin, and like we trust you that you're good for $100, but we don't necessarily trust Justin is good for $100. So that's where you can kind of get into this added dimension of who's the counterparty in this equation. Now, if Chase knows both me and both you, Chase might be like, oh, hey, listen, Justin's cool. We know him. Yeah, Justin knows us $100 and you us $100 less. But this is the key thing. When you have this extra dimension of who the counterparty is, it's like subtraction. Because unlike 1 plus 3 is the same as 3 plus 1, 1 minus 3 is not the same as 3 minus 1, even though you're using the same numbers. And so the point is you have to have this extra bandwidth to talk about in this very silly example, the counterparty, or to express belief in the counterparty before we can reshuffle around liabilities to transmit value. Along a similar vein, this is where it gets back into the BIS report. This is just simply talking about counterparty risk. But when you start factoring in KYC, which is just bankers jargon for know your customer, and AML, anti-money laundering, then you have additional complexity that's added to the system. And not to go too much off on the system, but again, if this system's been around, let's say in its present form since the 50s and 60s, and has lasted as long as it's lasted, I think there's something to that. You know, we're asking it to do far more than what it was originally designed to do. Imagine like you're building like a database or whatever way back in the day with very, very simple technology. Like you don't necessarily have even if you're a bank, you don't necessarily have, you know, the resources or whatever to have these massive databases synced on a worldwide basis. You might just have, you know, a few ledgers or whatever, right, that you have to keep in sync or whatever, and that might be the extent of the computing power. But nonetheless, you know, nowadays, and again, this was in 2016, it's probably only increased ever since then, you have this added dimension of not only the counterparty risk. In other words, is the person not going to pay, but also is this person doing things we don't necessarily like that the person will be doing? And banks themselves, they might be agnostic. In fact, they probably want to be agnostic in this entire equation, but at the same time, they don't want to get, slapped by regulators, as I'm fond of saying. Banks don't give one, what about following the rules. They do, however, care a great deal about looking like they follow the rules. And there's a very nuanced difference between those two things. The reason, Chase and HSBC or whatever, right, have, massive compliance departments isn't to help the bank stay within the law. It's to help the bank break the law, but staying within the letter of the law, but not necessarily following the spirit, is what my cynical self would argue. Anyways, let's go back to this report or whatever, right? So the key thing from all of this is that the report's basically saying in 2016, correspondent relationships were starting to wither, or you saw this aggregation where the big players were kind of scooping up the volume into themselves because they were the only ones that had the power to build out the internal mechanisms to shoulder the regulatory burden. Anyways, so basically you can see this recommendation for Know Your Customers, KYC utilities. And this is where you start adding, so we're talking about the legal entity identifier in this regard. And the other things, it's basically just the concept of how do you add more context with the data that's being sent over. And the tricky part is that when you do this, you're trying to expand a database that wasn't really necessarily, it was built with technology, or not technology, but it was built
to sail, not to fly.
Exactly. Yeah. And
you're asking way too much of it. I'm like, why would a bank whose job should be to make money on their loans? I want to make a profit as an entrepreneur, so I go to a bank to take out a loan to fund a business. That bank their goal should be to fund businesses that are going to make money. Now we're trying to make banks to decide what is good and what is bad. We are trying to make them play God and say, you know what, you seem like a semi-sketchy person, Josh. I think that you could do some nefarious acts with that money. Now I cannot give you that money morally because that is a bad thing to do. Why are banks playing God in this aspect? Yeah. And then that provides so many issues on the back end through the technical side because there's this additional part that just should not be there in the banking system.
Yeah, so two things happen. Number one is that banks probably don't care one way or the other, but they do care about getting in trouble with the regulators. And so basically the banks are being put into this impossible position in a sense to say, okay, well, wait a minute, you're saying that we had a duty we should have known. And if we should have known this and we didn't know it, and we didn't know it through our own negligence or whatever, because we missed something, now we're suddenly getting in trouble and we lose, and this is the key thing, we lose confidence, with our peers and confidence with the regulators. Banks are like, well, anyways, banks are going to be happy.
So what does that encourage? It encourages banks to find another way to make money. And so what do we see that they're doing? They're getting that same yield that they would be from the loans and getting them through financial engineering, through these humongous derivative swaps. Check back to the BIS report that's going viral, where there's $80 trillion of off-balance sheet dollars circulating in the euro dollar market. It's probably much more than that. But This is just an example of banks trying to chase that same yield that they would otherwise been from loans that they no longer can for multiple reasons, partially because of how systemically injured the financial system has been since 2008, because we've been in a complete loss of confidence. Not complete, but if we were running at eight cylinders of confidence, we're probably at 6 or 5 now.
Yeah, material diminished. And there's two other aspects as well. Number one is think about what's going on if you're an American abroad or whatever, right? The big banks abroad, they are actually, you are strongly discouraged as an American to open an account with them because they themselves say, hey, listen, even though we think you're on the level, like we just don't want to do business with you because we do not want to have to answer to American regulators, even if we're, a Swiss bank or whatever, right? It's just not worth it. I mean, this is not a specialty where we don't want to have an army of accountants and an army of compliance lawyers. Like, no, the business isn't worth it. So that's the first thing, Josh. And the second thing is that consider all the small and regional banks, the actual banks that are tasked and probably the closest to the ground with connecting currency creation to productive growth of the economy, financing mom and pop, whatever, so they can build a shop, start a, workshop or whatever, right? These guys suddenly can't play in this field because guess what? There's no way a credit union can compete. A credit union might be really good at, servicing, 5 or 6, local branches and, some, county or whatever, right? But if you think that they can, shoulder the regulatory burden to do with it, like, no, they're not a Chase, they're not a Bank of America.
This illustrates what you were saying perfectly, Justin. Look at this. Look at the red line. This is GSIBs, globally systemic important banks. These are the big mega banks. Then you have the large banks, and then you have small and community banks. So we can see the big, large, and GSIB banks. Their loans have been crushing it since this chart goes back to 2019. But they've been making loans, whereas The small and community-sized businesses have been they've had no loan growth, and in some cases, in small banks, we've seen decrease in loans. What does
Yeah.
this show? What kind of businesses are the GSIBs and large banks funding? The Apples, the Amazons, the companies that are already
Yeah.
highly established in mega corporations. What are the small and mid-sized banks that we can see are not making loans? What do they fund? Your everyday mom and pop shops that are
Main
really the
Street.
backbone of the economy. And we can see
Yeah.
that those banks are not making loans, even in proportion to the other banks. If you look at a chart of total bank lending, it's been substantially diminished. But breaking that down into smaller categories, the only banks who are lending are those incredibly big banks that can handle that regulatory pressure.
Yeah, exactly right. And let's go back to going back to this, just a few more things to note on this front is that at the most basic level, correspondent banking requires the opening of, well, actually, Josh, I'm going to leave on the screen just for a second. If you want to pause the video, you can pause the video and read this. This talks about, the mechanics of correspondent banking. We'll have a video more in depth on that in a second.
Yes.
Anyways, Josh, so kind of going back to this thing. So the BIS will have an international focus versus, kind of our focus where you and I would be a little bit more keen to probably what's going on in the domestic United States. But here's the thing. So again, this was all out of 2016. So the data probably is like 2014 and 2015 for all intents and purposes. But here's the thing I want you to pay attention to is that when you look at the number of active correspondents, look at Russia and kind of look at, this trend, because right here, you basically see Russia, and then you can kind of see what would become the emergence of this BRICS system, with the exception of China, starting to pull away from the existing system. When I say the existing system, what I essentially mean is that if the correspondent banking relationship, the Nostro Vostro accounts, are the key accounting mechanism, is maybe the way to say it, that ultimately underlies the Eurodollar system. Basically, it's the key accounting mechanism that allows you to transmit liabilities without transmitting assets. And you've got to have that for the Eurodollar, because remember, the Eurodollar has nothing behind it, or I would argue, has very little behind it, save confidence. But the thing, and this is more from a geopolitical angle, is that the BRICS, mainly led by Russia, see that? In 2016, you already saw this trend developing. Now, I don't necessarily know if Russia, from a geopolitical angle, was like, hey, listen, we want to get out of the system, so we're going to start doing this, or if it's just kind of something that would have happened anyways organically. But it's just something to note. Just something to note in that regard.
Yeah, so if they have, it's not just, it's really the BRICS nations. If you're looking at it from this angle, a lot of the Eastern European countries and Russia, if they have been trying to de-dollarize, which is definitely a possibility, and it's definitely been happening, but you still have to look at the total dollar-denominated debt out there. These are long trends in place. Brent Johnson, who kind of founded the dollar milkshake theory, he was talking about this back in 2016, 2017, probably looking at these same charts. But then you realize this takes an extremely long time to play out.
Yeah. Like I said, and this data was from 2016, so the data was probably a bit stale, and particularly after, COVID, it probably got really stale. And you could say 2018, there might have been some things there. But anyway, just I thought it was a very interesting take on from the BIS in terms of correspondent banking relationships. And I would say it kind of highlights the trend where there's this growing need for a new way for banks to talk to other banks. Josh, so to answer your question of what are we going to transition to, whatever system we go to, we need to go to a system that has more way to share information at the base layer, because that's what's currently not being shared. And we're asking it to do it when it can't. That's not fair to anyone.